Welcome to the market update desk, March 4th. Well, we got a lot going on today. Scott Riley, the market update desk, NMLS number 157524. Let's get right into it. Uh, Stocks are lower. Mortgage bonds are continuing their run today as we start. 10-year yields are sitting right on our target of 4.12, which was the 200-day moving average, the low end resistance level. And that's a very important metric to watch as we go into a potential crossroads. Oil prices got a lot going on there. Oil prices moved lower to $67 a barrel. News that OPEC will be gradually increasing production in April. Now, oil prices are declining in response. That's great news because it could give us some benefits within inflation data, because that metric of oil and gasoline flow into the utility costs, which flow into all the other costs on goods and services. ISM Manufacturing Index. So the February ISM Manufacturing Report came in beneath expectations at 50.3. As we go into it, though, may not be as bad as what it's first portrayed to be. New orders are being shown as declining by 48.6. And the media made a huge deal about this, especially listening to CNBC, because it's a headline and that's what they're talking about. But when we look deeper into it, new orders in January surged, most likely due to companies loading up on inventory ahead of potential tariffs. So if we looked at an averaging of January and February, which looks at the average of those 2 months versus just one, comes out pretty much just as expected. So because of that load up, it's making February look much worse than really what it was. Bonds, which is a great indicator, responded nicely to that. So you can see the bond traders are going in a little deeper than what the media headlines are. The employment component fell from 50.3 to 47.6 and is in contraction. Now that's ahead of the all-important jobs week this week. Now several reports are corroborating that we're in a weaker job market. We've talked about this. Now we're going to see what shows in that very potentially unreliable BLS report on Friday. We're going to wait to see what that shows, specifically what is within the in the birth death model for new companies being formed. One interesting thing, we talked about a decrease in GDP by the Atlanta Fed yesterday. They lowered it to a projection of negative 1.5% yesterday. Today, they lowered it again to a contraction of minus 2.8%. So there's a lot going on, not only week by week, but day by day right now. So it's kind of interesting and tough to keep up with a lot of it. Now, today, President Trump announced the beginnings of additional 25% tariffs on Canada and Mexico, as well as an increase in existing China tariffs, bringing those to 20%. Now, we did also see retaliatory tariffs from Canada, and also an increase on tariffs from China. So we'll have to watch how this plays out. When we look into this, though, we additionally are seeing the US dollar has risen by 6% since September. This is having a somewhat balancing effect because of our dollar being worth more. It's lessening the impacts, theoretically, from these tariffs. So apartment lists rental report that released its new index this morning, showing that new rents rose by 0.3 in February and are now down 0.4 year over year. The year over year figure moved, to a total of minus 0.5%. Now this is showing that rents are decelerating. In fact, when we look at apartment lists and Zillow's rental numbers, that's an average of 3.4% rental increase between the two of them. And if we average those two, it actually gets to about 1.6 rental increase, which is much lower than what's being reported and used, the data within the PCE report, which is 4.5% rental increase. It's having, as we've talked, a unbalanced effect on inflation by not having real-time data, but these lags in rent are still playing out within the PCE data. In fact, vacancy rate now up to 6.9%. That's a pretty significant increase from 2 to 3 years ago when it was negligible vacancy rate. This is coming from the mass amount of rentals that are coming to market, and that's affecting total rent renewals. CoreLogic reported that home prices were essentially flat in January, up 0.04%. Year over year, they're reporting 3.3% rental increase. Now, obviously, locally here in West Michigan, it's significantly more than that. On the technical side, we talked about the 4.16 that we're at. Actually, I'm sorry, 4.176 in the 10-year bond. It's an important crossroads. Tonight, we have the State of the Union. There's going to be positive and negative on that, depending on which affiliate you are and how the media reacts to that. So we're going to pay close attention tomorrow morning on how that affects the traders, both in equities and bonds. And also tomorrow we get the ADP payroll report. That's our first insight into the jobs numbers for the month. So we're trending in the right direction, but with the volatility between the geopolitical and the jobs numbers, be on guard. Could potentially be some volatility. Hopefully, we get it in the right direction going downward for the bonds, which decreases mortgage rates. Give us a call, 616-293-2189. Help you get pre-approved, explain the market, and make sure you get the best loan program for you. Take care and have a great day.